is the earlier stage companies working with outsourced or fractional CFOs before they're ready to hire their first in-house finance people. And that's obviously what we're going to be focusing on during this webinar today. We at Causal, we partner with lots of different fractional CFOs. I think it's really becoming a bit of a best practice for early stage companies. And so very grateful to have these four wonderful guests with us here today who are also partners of ours at Causal. And so what we'll do is go through one by one and introduce our panelists and then get into a bit of a discussion. If you have any comments or questions, please leave them in the Zoom chat. We'll try and get to questions either during the discussion or at the end, depending on how relevant they are to what's being talked about. And so, Debbie, let's start with you. Would love to just sort of quick intro on yourself and your firm.
Yeah, great. So my name is Debbie Rossler. I work as a fractional CFO with a firm called Birkeland Associates. We provide outsourced fractional CFO, accounting, HR, and tax support to early stage venture-backed startups, usually between the seed and Series C stages across a big range of industries. I've been working as a fractional CFO there for 10 years now, and my expertise is working with SaaS companies.
Awesome. Great. Thanks, Debbie. And Christian, maybe you can go next.
Amir, thank you for having me on. My name is Christian Marquez, founder and CEO of Finstrat Management. We provide hosts of services to early stage venture-backed companies, as well as investors, family offices, as well as venture capital. For purposes of this call, scope of our services in the simplest terms is we mimic an in-house accounting and finance team. So we take responsibility for the books, heavy emphasis on GAAP because of, generally speaking, investors are investing in AI and SaaS companies and they want to see these metrics and they only work if you know RevRec. But also back office, a heavy emphasis on FP&A and of course, all things fractional CFO. Working predominantly with companies in the US, seed to Series C. And me personally, see 2024 marks 2 decades as a CFA charter holder. While I'm serving as a CEO today, when I started the company way back, I was wearing a fractional CFO hat, so I've accumulated nearly a decade of experience in that space as well.
Awesome, great to have you, Christian. Connor, quick intro.
Yeah, thanks for having us. So started ScalableCFO 3 years ago. So we actually, a smaller portion of our business is kind of venture-backed businesses. Probably 75% of our businesses kind of cash flowing small, medium-sized businesses looking to kind of maximize cash flow reporting, FP&A, who maybe aren't growing as quickly, but still need some kind of general financial guidance. We've grown in the last 3 years from a team with just me for the first year to a team of about 15 people. And like I said, focus more on kind of a lot of acquisition focused teams. I worked in M&A, my background, or people that have just acquired a business and now obviously have a very different business to run with tons of debt on it versus tons of cash, like on the VC side. So it's a very different sort of problem. Yeah, hope that gives some context.
Perfect. Yeah, thanks, Connor. And finally, Dan.
Yes, hello everyone. Yeah, my name's Dan. I'm the founder of Rora. My story, probably similar to a lot of accountants, started in a really big firm, felt a bit lost, so gravitated towards working with startups, which was way more fun. But a lesson I really learned was that although we were quite well set up to do the tax and the payroll and the year-end stuff, what the startups we were working with really needed was someone to come in their team and help them build systems that they could grow with. And yeah, I hit on that fractional model just like everyone else. And we really focus on that operational side, the software automation, all that kind of stuff, what we call FinOps, finance, operations and technology. And yeah, so our team was just under 60 people, primarily based in London and the UK, but we've got some people around the world as well. So that's us.
Perfect. Thanks so much for the intros, everyone. Maybe to get us started on the discussion, I think probably a lot of our attendees here today are, some smaller companies who are probably thinking about, how to set up their finance function. Should they hire a fractional CFO? Should they just get some internal operations person to handle finance? Should they make the first finance hire? And so I'd love to maybe kind of start there and get you guys' opinions on sort of when you see companies deciding to hire fractional CFOs, when you think is kind of the right time to bring someone in that's sort of not too early, not too late. And Dan, maybe we can start with sort of your perspective. When do you typically see clients starting to think about this, and when's kind of a good time for attendees to bring in a fractional CFO?
Yeah, the majority of the companies we work with, they tend to have just got set up with an accountancy firm. You obviously need someone in place just to do the filings and that kind of thing for you. And then they tend to work with that, in my experience, until they feel significant pain. And then as soon as they've got that pain, they're feeling like they've outgrown that accounting firm, someone else comes in and inevitably wishes that they'd come in a lot sooner, because it's a lot easier to clear that stuff up and build from scratch than it is to come in and do it after the problems have already been caused. So I would say it obviously depends on your aspirations and your budget, but as soon as you can afford to, really, I think it's a lot better to get something that's built and bespoke for you rather than relying on an accountancy firm. Most of the companies I work with, I see that they start off with the CFO side. Actually, my personal take is it makes more sense to start with a kind of mid-level, more of an operational level, like a head of finance type person, somebody who, like CFOs, I guess people use that word to mean a lot of different things, but in my mind, traditionally, they're thinking of like strategy, fundraising, forecasting, all of that kind of stuff, which I think founders are often capable of doing themselves initially, but the big gaps that are going to cause them a lot of pain later on is the running of the functions, setting up every system, picking the right software. So I think they tend to start off with a CFO and then a bookkeeper, but actually in my mind, you're better off starting at that mid-level operator.
Got it. Super interesting. I mean, Debbie, Birkeland has sort of hundreds of clients across the US. Are there any sort of patterns that you see? Do you sort of share a similar view as Dan around, bringing someone in as early as possible?
Yeah, so I think a slight tweak to what Dan just said. We work with about 850 venture-backed startups, and we actually start with startups really from their initial fundraising. So pre-seed seeds companies, right after they get funded, we find it's a good time for them to start bringing in outsourced services. At that really early stage, the services they're going to need are more focused on the accounting and tax support, maybe some support with payroll once they start getting employees as well.
Right.
And then looking to bring in more of the strategic finance, either FP&A or CFO support. That tends to be brought in usually around sort of as they're heading into raising a Series A. Typically, when the companies are getting closer to revenue, when they're starting to think about building out a financial models, around the time that they're thinking to bring in that type of support. And then generally speaking, the life cycle of that is that it makes sense to continue with fractional support. It's a very economic decision. So once the support needs grow beyond 2.5 days a week of support, then it starts getting to be more economic to start bringing that same support in-house and hiring in-house. We find that cycle typically lasts up until around the late Series B to Series C stage, at which point sort of most or all of the finance team is going to be in-house by then.
Right. Yeah. Yeah, absolutely. That makes a lot of sense. Yeah, I think Series A was around about where we at Causal kind of hired a sort of outsourced CFO, fractional CFO for our own finance stuff. And I think we kind of went through the same process that most people do, where we had a kind of a hodgepodge of sort of random sort of bookkeepers / accountants at various points in time, not super organized, not super well managed. And I think there was for me quite a lot to clean up once when we did bring in the fractional CFO.
Yeah, and just to sort of add to that, I mean, that's where firms like Birkeland and some of these other firms, getting them their accounting, which is really geared towards working with venture-backed startups versus working with sort of an outsourced firm that doesn't have that specialization, makes it so that you can sort of work with one group sort of end to end until you sort of are able to hire in-house. Makes a lot of sense.
Yeah, for sure. I'm curious what you guys see as sort of some of the biggest mistakes that you do have to clean up when you start with a client. I'm sure that you've all seen quite a range of different situations. Christian, maybe we can start with you on this one.
Yeah, so this is going to kind of dovetail into your previous question, but 99% of the books that we inherit when we onboard a new client are a mess. right? It's not a question of if, it's just a degree.
Right.
And in it, and it's at this point, it's totally expected. You know, as I mentioned, we're predominantly onboarding early stage companies. Said another way, these are companies that don't have in-house accounting and finance teams that we have on occasion displaced in-house
Oh,
accounting.
wow. Okay. Yeah.
But what I see is just that a lot of the accounting and finance shops, whether they're CPA or not, that are servicing the front end of the market, they either, you know, not staffing people who are familiar with accrual accounting, or it's just, you know, not their focus,
Okay.
given what they're doing. And so because we're working with, you know, primarily tech, i.e. subscription-based businesses, or usage-based businesses, you know, that emphasis on getting accruals right isn't there. And so, you know, as an organization, we spend a significant amount of time up front getting everything in order, because everybody wants their dashboards, everybody wants, you know, their forecasts and their budgets to be coherent. But if it's prepared on like a cash or like a quasi accrual basis, it just doesn't work. And so we'll spend a lot of time just getting the ship straight. And, you know, we as an organization have learned to be very transparent in the process, because God bless founders. You know, I'm a big fan of entrepreneurs, but they want everything yes or no, and I don't blame them.
Yeah.
But, you know, once we get there, leveraging tools like Causal, very, very valuable. Because now we're in a position to not only forecast revenue, forecast expense, but, you know, be able to understand what our short and mid long-term cash flow projections look like, because we're appropriately accruing revenue and expense.
Yeah.
So I would say that's, you know, generally speaking, the first 2 to 4 months of an engagement.
Nice. Yeah, makes sense. Connor, how are things for you? You kind of work with a slightly different segment of the market than just sort of VC-backed companies. So maybe you kind of see a lot of different stuff.
Yeah. I mean, Christian hit the nail on the head. I mean, it is no one fires a good bookkeeper because it's not something that in our perspective is like a needle mover. So if you're broadly pretty happy with your bookkeeper, you're not going to change.
Yeah.
And so usually it comes from, hey, I'm getting financials, but they just don't make any sense. Can you help? Right. So that's kind of the start of a lot of conversations. And so I won't kind of beat that anymore. But I think the one maybe more unique thing for us versus a true traditional venture-backed business is like real goals, right? So in the venture community, I think they're a little bit more like, hey, go build a big business, do it really quickly. And I get that that's probably too far of a generalization, but it's kind of the broader category. Whereas for us, like this might be a guy that just bought a $12 million plumbing or HVAC company in Ohio, right? Like he doesn't want to go do that. He wants to try and make $750K to $2 million a year of free cash flow, take it out of the business and try not to work 100 hours a week.
Yeah.
Right. And so a lot of the time what we run into is not clear outlines of like what they want this business to be, because the outcome can be, you can go try and buy 50 plumbing companies if you want and roll it up and sell it for $1 billion. But you can also just make a great living, making a couple $100,000 a year and working 32 hours a week, right? Whatever it might be. And so one of the things that we try and really work on is setting much more like tangible roadmap around goals of like, okay, here's what is realistic for this business, and try and match that a little bit with what the owner wants, and then kind of allow that to guide us a little bit with where we go from the CFO and reporting angles. But I would say that's probably those are the two things that we either struggle with or have to kind of get on the same page about before we start diving into things, because it's a little bit different of an angle.
Yeah, absolutely. And do you guys, we've kind of talked a lot about sort of the bookkeeping side of things and how that's obviously the starting point of just getting the numbers correct. And there's usually a lot of cleanup work there. Do clients typically have existing like financial models that you guys use as a starting point? Do you always kind of start afresh? I mean, one thing I've seen a lot of is, you know, some sort of very early stage company might be like pre-seed or something, and they might have some like investment banker friend who has built like some crazy financial model for them that's sort of way overkill for where the company is. Yeah, I mean, do you guys typically just sort of start afresh when it comes to things like a financial model or a budget, or are you often kind of working with an existing thing? Dan, maybe we can go first with you on this one.
Yeah, I'll be really interested to hear how this experience fits with other people, actually. But what I've been seeing a lot more, certainly recently, and it kind of surprised me, actually, it's kind of the opposite of what Connor's describing there with the more like, I guess what you might call lifestyle businesses that are figuring out what goals make sense for them. The founders I've been working with a lot in London recently, they're almost like kind of over-indexed on the model. They've got a model that's almost too thought out. They're living in it every day. They see the main thing that they've got to do as like getting in that VC money. So they're like living in the model all the time. So often actually we would kind of take the focus, that wouldn't be the main thing we'd be looking at and spending lots of time with on day one. Obviously it varies. Sometimes it's too much and you do need to have something more sensible. But the biggest thing that I find founders want to talk about when we bring them in is that they're spending too much time on the finance. That's the biggest, like whatever the mistake is, whether it's cash accounting, whether it's they're paying all the bills themselves, whether it's there are mistakes in payroll, the place they feel that pain is that they're spending too much time. And generally that's because there aren't systems and processes in place. And again, for me, that's why like that operational level, someone who can build the systems and processes and checklists is a key starting point. If you bring in a bookkeeper first, they generally just kind of crack on with things. They don't design systems and processes. They just reconcile bank statements. If you bring in a CFO, depends on the person, but generally they don't want to be setting checklists. They're not people who generally go straight to checklists. They're thinking about forecasting and that kind of thing. So yeah, I don't know. I sense maybe we might be in the minority there, but I find that most founders I've been working with are like, they're living in the forecast already. They spend a lot of time thinking about it, a lot of time working on it.
They do kind of too much of that stuff.
Sometimes, yeah, maybe. Or at the very least, it's not the most burning problem that's on fire that needs putting out.
Yeah, yeah.
Yeah, I would add that it really, I think it depends on the stage of the business. If you're, call it under $1 million in revenue, or if you're seed, maybe you have some convertible notes in place. And so said another way, you can get away with not having a clean financial model or a coherent financial model. But I think that's probably a good stepping point when you start to think about bringing on a firm that has a fractional CFO, because if you're going to do an A, investors are absolutely going to expect to get a little bit more insight and transparency in the business. Shout out to Causal, great tool in that regard. And Tamir, you and I have spoken about before that I still think that one of the reasons why Causal, is best in class is the fact that you also have this Excel export. And I think this is really important. Because very practically, most founders are going to look to the CFO team to know Causal, but they're still going to want to be in there a bit and or give it to investors. And so the fact that you're straddling the fence, I think, is a big advantage of the platform. But Dan's right. If I'm the founders or the C-suite, and I'm going to take the time to invest in a team, we should really be handing off everything modeling to the experts. Let us handle. And let them focus on product development and sales and marketing. The fact that most models that we get are, again, they're a mess. You look at the balance sheet, assets don't tie out with liabilities and equity. It's par for the course. And I think more importantly, your audience who's thinking about approaching investors, many VCs, they see it too. They get it. I think it just really depends as how mature the organization is before they're like, okay, let's get your house in order.
Yeah, yeah, for sure.
Yeah, I would say in my experience, like 9 times out of 10, probably the first big project I'm doing with a client is working on the financial model.
Okay.
My experience, most of my clients are sort of Series A, pre-Series A, and most of them don't actually have a model coming in. But when they do, more often than not, it needs to be reworked.
Yep. Are there any sort
I
of
would say
Oh, go ahead.
we're more similar to that of most people don't have a model when they come to us. And it just like, I'm more in the camp of we build something pretty simple, and then we will upload it to some sort of dashboard platform like a Causal, and let people kind of play with it within the rules that we allow them to play with it.
Yeah.
Because most of the businesses we work with are super simple. Like if an owner or founder, whatever it may be, is spending too much time in it, then they're probably losing track of it. Because I'm a big believer, like every business that we work with has probably no more than 5 things that drive 90% of the business. So if you're playing with more than that, you're just wasting time.
Yep. Yeah, I think that's definitely a trap that that we've seen a bunch of people fall into. I think one thing that would be useful for attendees who are kind of thinking about fractional CFOs right now is to just understand sort of day to day or week to week, what does that relationship look like between the client and the fractional CFO? Are you doing like weekly calls with them? Are you in their like Slack channels? You know, what would it actually practically look like working together with you know, with a client? And if you can kind of just give a flavor of how you guys typically do that. Connor, if you want to maybe start on this one.
Yeah. So we really kind of have 2 in our world, like operating models. Depends on the size, the scale, and the scope. Like if they're really messy and have a lot going on, like we get a lot more people that come to us very early to say, hey, we have a cash flow issue that we need to hop into a little bit quicker, or we'll be a little bit more involved, where we're touching base at the bare minimum weekly. But then I think kind of once you get into a good, comfortable spot, we're really kind of zooming out a little bit and saying, okay, like I think Dan, you said it, but like you can get to the point where you're spending too much time in the finances of the business and not relying enough on your financial partner. Like, because that in our experience has just come back to like, we are not providing enough transparency. If they feel like if we're in a good spot with the business and we need to be getting on the phone all the time, it usually means that something is not working, whether that's cash flow or reporting or transparency or accounting or whatever it might be. There's usually some error that's happening in the system. And so what we're trying to do is kind of get to a place where we can kind of just rely on the reporting, the analysis, and kind of the strategic conversations and letting those things play out. But usually it's kind of some sort of weekly for the first, depends on the client, but 4 to 12 weeks. And then we kind of back out into 2 times a month, is the general structure. And we're pretty flexible on that. But like we only set the standard of 2 times a month because we just feel like we've got clients from $1 million to our largest will do 150 million of revenue this year. And we just find that they just don't need more if we can handle good reporting and analysis and have good conversations.
Yep. Nice. Debbie, what about for you? What does that relationship typically look like?
Yeah, I'd say it's quite variable largely based on the stage of the company, but some other factors as well. I would say sort of at the earliest stage where a CFO might come in sort of pre-Series A stage, I'd say we're sort of maybe averaging around 4 hours a week of work. And that might be a weekly call, that might be a bi-weekly call. A lot of times the involvement will sort of center around specific deliverables like board meetings. Sometimes those earlier stage companies may have board calls even on a monthly basis. And so a lot of the involvement will sort of be in the lead up to the board meeting, in the closing of the books, but then also, involvement, anything around financial modeling, pricing, all that kind of stuff, sort of spattering throughout the rest of the month as well. As the company grows and scales, we are part of the executive team. And so when you start building out an infrastructure with, executive team leadership meetings, we are participating in that. I've worked with companies as late as Series C, where my role was more like an interim CFO, where I was working 3 or 3.5 days a week, which is a little more unusual. It's not a long-term sort of what we do on a long-term basis, but at that point, you're fully in it with the executive staff, meeting, throughout the day, pretty regularly. So it can vary in scales as the company grows.
Nice. Christian, anything you want to add from your side? And I know you guys have kind of a range of different clients and scopes, obviously.
Yeah, the short of it is depends. So our floor would be a call a week. And it sounds a bit trite, but I find it's really valuable. I mean, something as simple too as just coming prepared with an agenda.
Yeah.
Is a big deal. And we use agenda software that enables us to roll forward agendas from the previous week. And, the spirit of it is just being transparent and making sure that we're staying on top of everything. That said, at any given point, a client may be going through an audit, closing a debt facility, preparing a press equity round, having a board meeting. And so, at least as it pertains to FinStrat, I feel very strong of bringing to market an offering where we acknowledge the fact that, these are early stage companies. They need a lot of hands-on attention as it pertains to accounting and finance, as founders don't necessarily have the background, but it can be really crucial to keeping the business alive and growing. And so we make ourselves available for ad hoc calls as well. But really, we're looking for at least a call a week.
Nice, awesome. And Dan, curious to hear from your side. I know you have sort of a few different levels of seniority of people that different clients work with, like a different mixture of these.
Yeah, exactly. So often they'll be getting a senior person and a mid-level person and a junior person, for example. The mid one is usually the earliest one they bring in and the one they use most of. My kind of thinking of it is they want to feel like they've got at least that one person in their team, but the whole of Rora, the whole of our company in their corner, kind of behind them. Generally, we don't do that frequently, less than a full day a week at each level. We find that to meet that promise of feeling in the team, leading the function, you want to be present, you want to be talking to the heads of the other functions, you want to be getting the context from the stand-up, you want to be knowing the latest gossip at the social that the head of sales hates the head of engineering. If you're going to run the finance function on that mid-level, that operating basis, that's what I think you need to do. We're not like standing from the outside, giving financial advice. We're getting in and running that part of the business, that function. I think, we think less than a day a week makes that quite tricky to do. It's possible, but it's tough. And then, every Wednesday morning, our team just has like peer sessions and L&D sessions. And that's the time where they would come together and say, I'm currently working on this SaaS company with X problem. How have other people solved it? And bring in that knowledge of the wider peer group. And whether you're working as a fractional CFO as part of an organization or by yourself, I really encourage people to use those kind of peer networks. I think that's a really valuable resource, and just makes it feel a lot more fun and a lot easier when you're otherwise doing what can be quite a lonely role.
Awesome. Very interesting. Thanks for sharing that. We've had a few Q&A questions on Zoom, so we can pull out a couple of these. Chandler is asking that there are many different fractional CFO services and firms. What qualifying questions does one need to have answered to find a firm or a service that's kind of a good fit for their company specifically? Dan, maybe you can start on this one. How would you recommend?
Tough question. I would definitely recommend talking to other startups or organizations they've worked with. I definitely see in London that founders are very well networked with other founders, either as part of their VC kind of portfolio or other groups. And I think talking to them, you'll get a good sense, not just of the types of problems they have as a business, but also the type of founder they are, because some founders are much more analytically minded, who live in the forecasts, who can also do already a lot of the financial strategy. Some of them are much more like product based or even like sales and marketing based, and each of those founders will want different things from their finance function. So I would definitely not skimp out on the step of asking those people who they use and then getting the real review from them, or alternatively going the other way. When you talk to the advisor, say, what businesses are you currently working with that have a similar profile to us? I want to hear from them. So that would be a starting point for me.
Nice. Debbie, what's your advice to companies looking to evaluate different firms?
Yeah, I mean, I definitely agree with what Dan just said in terms of, referrals are really critical. Like Brooklyn, the vast majority of our referrals are coming in from venture capital firms and then previous clients that have worked with us, and sort of having that sort of strong word of mouth, I think, is really, really critical. Certainly, what we see sometimes where we get clients coming in that have sort of messy books, a lot of times the problems that they're having is that they weren't working with a firm that was specifically focused on working with venture-backed clients, because there are sort of specific needs, specific expectations that venture capital investors have for the books of startups. And so making sure you're screening for companies that have, number one, the expertise. If you're a venture-backed company, have expertise that can get you on the path to sort of be able to raise capital over time. Certainly industry expertise is really helpful as well. So, you know, Berkland has sort of specific vertical expertise like SaaS, healthcare, fintech, that type of thing. If you're in a specific industry, finding someone, you know, a firm that has expertise with that is really helpful as well, are some of the things that I would look for.
Yeah, makes sense for sure. Christian, Connor, anything you'd add to that?
Dan nailed it.
Maybe, yeah.
Oh, go ahead.
Go ahead.
I was gonna say, Dan nailed it. References are really valuable. You know, the one thing we didn't talk about is cost. So we didn't explicitly talk about this idea that, hey, your business may be transitioning from, you know, or preparing for a Series A. But I think a lot of times, you know, founders have a belief that it's a natural progression, but don't necessarily understand what stage their business objectively needs to be at. And generally, I would say it's growth, something that looks like product market fit because you're doing $1 million plus on reoccurring revenue. And I say that's important because, you know, when you start bringing in expertise like a CFO, obviously it's just going to cost more than if you're just using a bookkeeper firm. But if you're still running in the red, you know, that's a really important consideration. And so, you know, I'd also make sure you're really clear on what the cost is going to be of hiring one of our firms. Because while you think you may need the services, I'd also just make sure that you can afford them in the long run. You know, there will be times when you know, we'll turn clients away and simply say, hey, we don't think you're ready for us yet, because we don't want you to contribute to your burn and find out you're in a bad position, especially in today's interest rate environment where rounds aren't closing as quickly as they used to. But all that said, yeah, references and ensuring you're clear on the scope of services and how they're going to contribute to the larger overall strategy.
Nice. Yeah, that makes sense for sure. Actually, Connor, do you want to go quickly on this one before we move on to sort of pricing and how much these services typically cost?
Yeah, I think this will be quick because I think everything that they've said, I can't say it better. The only other thing that we have found successful is kind of like deciding how businesses want to grow and make sure that we have experiences that way of like, is it just more paid ads? Is it partnerships? Is it through M&A? Those sorts of things of like, what is the finance function actually going to be assisting with? That is more than what I would call base level CFO services has been a big value add for us. Cause like I said, I have background in M&A, but like, I don't have a big background in like partnership based, like true contractual based partnerships. And so like the economics of those sorts of things are so different that we have found that we've had more success in the M&A market versus some of the others because of like the specific expertise and like how they're deciding to grow.
Nice. Yeah, for sure. We have a question from Shubham asking, what's the typical pricing one should budget for the cost of a fractional CFO? Is it usually a monthly rate or an hourly rate? I imagine you guys all have sort of different ways that you price, different kind of ballparks in which you typically play. But yeah, it would be great for attendees to just kind of get a sense, high level of, you know, what that would look like for each of your firms. Dan, maybe you want to go first on this one.
Yeah, sure. Thanks. I guess I'm potentially a little bit controversial in that I hate the fixed monthly fee for the fixed scope. Big apologies if anyone here is a big fan. I really found when I was working in an accounting firm doing that, it just put all the incentives in the wrong place for me. I was always kind of incentivized to like use the most junior staff possible, try and count my hours and spend as few hours as I possibly could. When someone senior wanted to like come and give their opinion, I'd be like, no, don't talk about this client, because as soon as you do, I know that time's going to come on the code and you'll smash my budget. And it also just really put the emphasis I found on things that you can tick in or out of scope. Things like, have we got payroll in scope? How many transactions have we got in scope? And I think whilst that does work for a business with very predictable operations, for like a VC-backed startup that's still figuring things out, it's changing a lot of things. Things are going wrong, frankly, things are happening that are unpredictable. I just found that like calculating a scope wasn't a good fit for that. Didn't really reflect how I would want to work if I was in the business. So we flip that round and we do it based on how many days you need of each person each week. Like I said, we've got 3 levels of seniority, a price that's associated for a day of time of each of those people, and we do it that way around. Yeah, I know there are pros and cons to both models, but I'm a big advocate of doing it that way.
And can you share, like, let's say Series A company using sort of 1 day a week of sort of the mid-level seniority type person, like what would that cost them for you guys?
So the mid-level person is £570 at the moment, which must work out to be what, like $650.
Okay, cool.
$700 maybe.
Cool. So about 2.5 to 3K a month is kind of like what
Yeah.
Cool. Debbie, can you share what that sort of pricing model looks like for Berkland and sort of what the rough ballpark would be?
Yeah, so our services are generally billed on an hourly basis, and we do have also different tiers of employees. Bookkeeping, accounting is the most cost effective. Controllership goes up, and then FP&A and CFO, so sort of goes up from there. And in terms of ranges, like I'd say the general rule of thumb is the way to think of it is bill rates are probably going to be, if you were to pay a consultant full time, that would be roughly double the cost of if you were to hire someone full time. So when you think about it, if you have someone working a day a week, it's sort of the equivalent of paying that same job 2 days a week. And that's where the sort of math comes into play. Right. That, once you get over 2.5 days a week, that's when it's going to start making economic sense to flip. But I'd say sort of the CFO portion of the work can start, roughly around 5,000-6,000 a month, and then go up from there. And then once you get much higher than 25K a month, at that point, you're going to want to start, flipping the switch to full time is sort of the way to think about it.
Right.
But it does, because it's hourly, it's a little hard to put a pin on it, because it does vary dramatically by company.
Yeah, for sure. Yeah, thanks for sharing that. Christian, what about for FinStrat?
Yeah, it's interesting. I'll share my experience. So today it's a base plus variable, and the spirit of it is our fees. We use proxies within the business to invoice that are just based on the scope of work that we're doing. Didn't start the business that way though. Started it on an hourly basis, and I like to joke, but I quickly found out why people don't like lawyers. My very first client was rushing to get off a call. And despite having, a mess of books, wanting dashboards, wanting me to get on calls with potential investors. And so we pivoted to this model. And what we found is by eliminating hourly, neither party was managing the clock. And we were in a position to be able to dot I's and cross T's. And mind you, we take a bit of risk in so much as, if they're growing faster than I'm invoicing, we may be spending more time. Yeah. But we've structured our business really for long-term relationships with an emphasis on clients who are value sensitive. But we find it works really well because now we're also incentivized to innovate, because our margins improved when we can get the work done more quickly, of course, without compromising accuracy. But Debbie's numbers were in line. Our base fee at the fractional CFO tier is $6,500 a month, and it goes up from there. I would tell you, and I didn't share this earlier, but we only do implementations that are end-to-end, meaning we won't take on a fractional CFO client unless we get responsibility for the books, the back office, FP&A. Said another way, we're bringing an entire team: bookkeeper, staff accountant, controller, business application specialist, in addition to the fractional CFO. And if we were to look at the math, we're going to be anywhere from a fifth to a quarter of employing a commensurate in-house team. Right. The only thing I would tell you is a little bit different. I do get asked, okay, at what point do you bring this in house? And yeah, I mean, I'd say around Series C it works, but if I'm still going to be a fraction of the cost of employing an in-house team. So it really just a matter of when does the C-suite want access to a full-time CFO or team, and that's a bit subjective. I'd say, really just, I think when the business operations get so significant because of volume of transactions, that's probably one you want to start looking at it. But technology today is so amazing that we're able to support clients who are doing daily transactions numbering in the thousands through their business. And I've the other thing too, I mentioned earlier that we've displaced in-house teams. It's really hard, I think, to find competent accounting and finance staff. Just as a side note, and we could probably spend another call on this, but we've gotten really good at interviewing potential employees, and man, I feel bad for some people who have undergraduate accounting degrees who can't tell you if an asset's a debit or a credit. It's really kind of scary. And I only say that because the full scope of talent out there is not uniform. And I kind of going back to what we were talking about earlier, I would really kind of get in the weeds of hiring a firm to understand, help me understand how you understand talent, how many clients you're assigning to a team, what's your turnover like, before you decide to pull a trigger.
Nice. Yeah, that's super interesting. I think the hiring piece is I think a really good point, because I think if you're just sort of a founder making your first finance hire, I mean, typically you don't have the finance expertise, but you have to try and evaluate someone else's finance expertise, which is always a challenge. Connor, finally, what does pricing look like for you guys?
Yeah, so we are the fixed fee flat rate. 3,500 to 5,500 is where we sit. But I think based on what everyone's saying, like, it fits our business type much better because it is more consistent. Like, there isn't as much changing month over month. We usually don't have boards or investors to manage, and so we are a little bit more kind of steady state. Like, our engagement can look the same 12 months from now as it does today, and they just want the same thing that they wanted 12 months ago and make sure things are continuing to move in the right direction and moving towards the goals. And we've just found that that's been super successful for us.
Awesome. That sounds great. We're just coming up to time, and I think that's a very good and actionable note to end on. So if any attendees here are interested in bringing on a fractional CFO, see there's a bunch of great folks that you've been listening to on this webinar that you can reach out to, and hopefully now you also have a sense of what the price ranges and ballparks look like. Debbie, Christian, Connor, Dan, thanks so much for joining me. Super interesting to hear your thoughts on this. And yeah, I certainly from my side of the table, definitely feels like we see more and more people looking to hire fractional CFOs, much more than we had a few years ago. So definitely booming business, and we love working with you guys as causal partners as well. Thanks everyone who attended. Sorry if we didn't get to your question. Do feel free to email us, and we'd be very happy to help. Thanks everyone. Bye bye.
Thanks so much.
Awesome. Thanks.